Order. Welcome to the Treasury Select Committee on Tuesday, the 10th of December 2025. Today we are looking at the work of the Financial Conduct Authority. So this is the first time that we've had the FCA in front of this new committee since the election. I'm delighted to welcome the Chief Executive, Nikhil, who is with us today. He's joined, of course, by Alder, the Chair of the Financial Conduct Authority, and they're joined by Stephen Braviner, who's the General Counsel and Executive Director of Legal, Risk, Compliance and Corporate Governance at the FCA. Quite a long list there, Mr. Braviner. So today we are examining the work. This is one of our regular sessions, really, with the FCA, and I'm really pleased to welcome you because it's been an eventful few months. We've had the general election, the budget, the Mansion House speech, and you're partway through your transformation programme. So I thought maybe if I could start, Mr. Rathi, by asking you how the transformation programme is going and whether you feel that you've achieved what you set out to achieve by now.
Thank you, Chair. We've been engaging in a multi-year transformation in light of the fast-changing digital landscape in financial services, recommendations that came to us a number of years ago from various reviews, and also adjusting to the new legislative environment. And I think we're pleased with the progress we have made. There's always more work to do. There's always an intense focus to keep improving our operational effectiveness. But I would draw out a few things for the committee's attention. The authorisations gateway has become much more rigorous, but also we're meeting our statutory timelines in around 98% of cases. And one of the things we learned from past experience was that when things haven't gone so well, or things have gone wrong, it's often at the authorisations gateway that those issues have arisen, and I think we have moved that very considerably. We have stepped up quite significantly our use of data and technology. That's most visible in the way we tackle financial promotions. 3 years ago, we would be asking for about 570 to be amended or withdrawn each year. So far this year, that number is now 16,000. And that's because we've invested in our data, our technology, and other things which enable us to get to the highest risk situations faster and go after them faster. We have significantly diversified our organisation. So now, as compared to a few years ago, we had around 2% of our workforce outside London and the South East. Now it's 10% across Leeds and Edinburgh, and we're very excited about the brilliant talent that we're attracting into the organisation from all around the UK. I've always felt that was important because we are a regulator for the whole of the United Kingdom, of course anchored here in London as well. And as we've developed the organisation, we've brought in a lot of external skills into the organisation. So around half our leadership team does have financial professional services experience, which I think is relevant for the nature of the work we are doing. So those are some of the highlights, but I would never say that work is done. And we must always stay very focused on continuing to improve our operational effectiveness in a landscape which is fast moving.
Of course, you've got a new strategy that will be covering 2025 to 2030. You've had a lot thrown at you, and we've just seen your response to the Chancellor, which we'll cover in a bit more detail later on the remit letter that she's sent to you. What do you think you're going to see? What you're going to have to change significantly in order to both remit the remit letter and what do you plan to cover in your next 5-year strategy? And I'll come to Mr. Alder as well on this, Mr. Rathi.
Yeah, and I'm really grateful you've asked about that, because I think the accountability mechanism, particularly through this committee, is very important for us to make sure we're prioritising our resources and focus in the right areas. As you said, we have a very broad remit. It grows quite considerably year after year, so we have buy now, pay later and other things coming in our remit, but there's also some strategic focus that we need to bring to the organisation. And what we will be focusing on, and it's covered in the remit letter, essentially 4 things. Firstly, picking up the point we were just covering, continuing to improve our operational effectiveness, our use of data and technology, that remains a number one priority, certainly from my perspective, and I know Ashley agrees with that as well. You've seen the Chancellor's letter to us. We have also the new secondary competitiveness objective, and we want to make sure growth and innovation is a key strategic pillar that cuts across everything that we do, and I'm sure we can get into the detail around what that means. The next thing is consumer resilience. There is a very significant moment now in the UK to think about reform of pensions, reform of the savings landscape. How do we make sure that consumers are saving adequately, getting the returns they need to support their financial well-being and their retirements? And I think we have a significant role to play, along with others. This is a joint effort. It's not just the FCA, but that is a very significant piece of work for us, but also with a focus on vulnerable consumers as well. We want to take advantage of all the technology, but we have to make sure that people don't get left behind. And then thirdly, we've stepped up very dramatically in the last few years on financial crime, tackling financial crime. We have a record number of proceedings in the courts at the moment. Again, we're one of the players in the system, but we do think that that meets a number of our objectives. It helps with our growth objective, because the costs of financial crime are a drag on growth and competitiveness. It helps with our market integrity objective, and it helps with our consumer protection objective. So we envisage stepping up considerably on financial crime. So those are the things we are prioritising amongst all the things that we could prioritise, but that's what we are proposing to focus on in the next 5 years.
Okay, Mr. Alder, is there anything you wanted to add as Chair?
Well, I think the sort of background to the strategy and where we're at the moment, I think we're at a sort of bit of an inflection point. Not least if one looks at the Chancellor's remit letter.
Yes.
And I've written down here, just to be absolutely accurate, I think what is key in that letter, which is how to enable informed and responsible risk-taking by firms and customers, recognising that there are difficult trade-offs to make, and I commit to the government in supporting you in this. So that I think, in essence, is the challenge. As if we look at regulators across the globe, particularly in the large financial centres, most of them are asking themselves, or governments are asking them, similar questions, including in the EU, in fact. Nevertheless, I think here it's, if anything, it's a more high-profile, direct question around the relationship between regulation and growth than it is elsewhere. So that's, I think, where we sit. And I think the strategy we're developing, what crosses into that is this key question around the intersection between regulation and growth. I don't know if you permit me, it will just take, I think, 2 or 3 minutes just to go through, I think, in practice, what is happening on the ground and what is likely to happen on the ground in relation to this. There's a significant strand of work around growth, which is to do with reform of the capital markets at large. And there are kind of 2 components to that, I think, in our view. One of them is to do with enabling more UK businesses and others, but principally UK businesses, to get into the shop window for investment. So that goes to the changes to the listing rules that have taken place so far, a project with the acronym PICES, which is basically around the ability of members, sections of the public, to invest in private shares, etc. So that's the shop window. Probably the more difficult piece is under the heading of mobilising domestic savings, whether pension savings or whether private savings.
Called lazy capital.
Yeah, absolutely. And you saw, the statistics come out frequently around, for example, the amount of cash that as a proportion of overall savings, or retail savings, or public savings. So the question then is, what are the levers, or in particular what the regulatory levers are that one is able to pull in order to mobilise savings? That's, I think, is a longer-term project, but nevertheless, for example, the work we are doing on a new type of advice to fill the gap that arose, particularly post-RDR, when it comes to consumer investments, that's part of it. Reform of the PRIPS rules, that's also part of it. That's about a better type of and more useful information to consumers. So there's a kind of, and that really is on the demand mobilisation side of life. So there's a lot there to unpack, and clearly there's a big conversation around pensions as well, which featured very heavily in the Mansion House speech. When it comes to standards for firms, I think my view, Nikhil's view, and in the organisation, that standards for firms need to remain high. I think I said this at a previous session. This is not a return to pre-crisis light touch in the sense that was happening at the time, because frankly that ended in tears, not just in the UK but elsewhere. Yep. So when it comes to firms, I think the overall view of the board and the organisation, standards must remain high. However, there is a very, very, very good argument around proportionality. We've put out a call for input, for example, in relation to the handbook. As we move towards an outcomes-based approach, what does the community, both on the consumer side of life and the firm side of life, think about a shift from outcomes and arguably a simpler, shorter rule book, ultimately. So proportionality is important. There are a few projects which you get into that are directly around that. And then efficiency, of course, and Nikhil's touched on that, in terms of that's a large part of transformation, to make sure the organisation is more efficient. I would just mention, in that context of all of that, consumer duty.
Yes, we will come on to that.
Consumer duty is landmark, really, and again, as the FCA, when I was viewing the FCA from outside the UK, it is a global thought leader, and the approach to consumer duty is iterative and it's developing. It's really, really important, because a lot of the discussions around growth, consumer protection, are they in any way in conflict, kind of centres on how we develop consumer duty. So that's, I think, from my perspective, that's the kind of landscape.
Okay, well, we'll unpack some of that, but I think one of the challenges here is it's like a push me, pull you, that you've got to get consumer protection right while you've got this growth objective, and your response to the remit letter is quite interesting about you pull out some of that tension. So on balance, can you actually do both well, Mr. Rathi?
I think we can. I think it requires us to have a really good engagement with this committee, with other committees in Parliament that scrutinise us, and with the government. Parliament has asked us to deliver 3 primary objectives: consumer protection, market integrity, and competition in the interests of consumers, and has added a secondary objective to that, which we are embracing.
Would you say the government's added the secondary objective?
Well, it's in the legislation as well. So it was, which I believe had cross-party support in the last Parliament. But what Parliament
it's certainly been doubled down on by the new government.
And then we've always had a remit letter from the government, which asks us to take account of, requires us to take account of those elements of economic policy of the government that they particularly prioritise. That's part of the framework, and there's a very, very strong emphasis on growth, as you saw in the Chancellor's letter. What isn't defined in the legislation is the distance between primary and secondary objectives. And that's precisely what this accountability framework, I think, is all about. And the way we, I think, can navigate this is being very open with you about our evidence base. What we're hearing, I know you took evidence from a range of groups, industry and consumer groups, last week, and you heard the different perspectives. We lay out our evidence before you, and we try to surface some of the choices around risk and some of the trade-offs, and seek to secure as broad a consensus as possible. I recognise in Parliament and with government there's never going to be 100% consensus, but as broad a consensus as possible. That gives us then the strategic direction we can go in. Alongside that, we should always first and foremost stay focused and continuing to improve our operational effectiveness, and that goes without saying.
Well, we're not really planning to go too much into operational effectiveness today, but on the issue of this tension, I'm going to turn to Mr. John Glenn MP.
Thank you very much, Chair. Can I just focus in on the risk trade-off, if you want to characterise it as that? I mean, I think one of the big challenges in the Mansion House speech, the Chancellor spoke about the post-financial crisis tendency to develop a system that has tried to eliminate risk-taking. And that is, do you agree that that is what's happened?
I think that in the post-financial crisis, there was obviously a huge agenda around the world to reset regulation right across the financial system, particularly on banking, but everywhere. And that's because risk hadn't been managed effectively before 2008, and we saw the consequences of that around the world. I think that we haven't eliminated all risk-taking, but obviously there's a spectrum here as to how far you wish to go. And, obviously you're very familiar with this, and when you were a minister, we used to discuss this trade-off regularly. If I take the listing reforms, which Ashley talked about, so we led that process from the FCA over the last year or 18 months, and we have moved the listing rules in the UK radically to make sure we're aligned with our competitor jurisdictions. There was a lively debate, so there's a number of the market welcomed it. Pension funds were a bit more reticent because they're worried about the shift in investor protection. All the way through that, we have said very openly that this will mean more things will go wrong over time. I don't know when, but sometime in the next few years, one or two more things will go wrong, but that is necessary to shift the risk appetite that the economy needs for growth. I think the test will come when those things do happen, and what the tolerance is here in Parliament for some of those situations when they crystallise.
Can I just examine one of those that happened on my watch with London Capital and Finance? Because we had a situation there where there was a...
Should we just perhaps explain, Mr. Glenn, what you were doing on that watch?
Sorry, I was the Economic Secretary for 4.5 years, and so therefore we had a lot of interaction, myself as a Treasury Minister and the FCA. And that was a situation where there was a market failure, and it was deemed to be partly, I think, the responsibility of the FCA to have stopped that from happening. And what happened was there was an unregulated activity of an FCA-regulated firm. So I, as the Minister, got a judge to evaluate that, and essentially compensation was then granted, and it fell on the public purse to do so. Now, I got to be responsible for that decision, but what I think you're pointing to there is a situation where something could happen, where a firm, one of your 42,000 firms, is regulated, but there may be activities that aren't regulated activities, and that is for the public difficult to understand. And what you'd really need, I mean, what I'm trying to get at is what sort of cover do you need, or should you reasonably expect from this committee and from Parliament, such that in that situation again, we wouldn't be in a place where, the taxpayer would be culpable, because I think that's really the bottom line of this. And unless we define that cover, we're not going to get into a situation where you can actually move that forward. And I just wondered if you could reflect on what happened then and how we can avoid that happening, and what it actually needs to happen in terms of rules changing and public understanding moving. Because, of course, we've also got a massive lobby of people out there who say, well, the FCA failed, it's an FCA failure, somebody's got to pick up the tab. How do we get this trade-off and explain it to the public in a way that they can understand, so we don't have that sort of thing happening again? Or did what we did, was it the right thing to happen, and should it reasonably happen again in that way?
Mr. Rathi.
First of all, I think we as an organisation accepted the recommendations of the Gloucester Review, and Dame Meg asked me at the start, and we've implemented those recommendations, and particularly around the authorisations gateway, the way in which we monitor the financial health of firms. There is a trade-off there, because the more intrusive we get, the more you hear from industry groups that this is onerous and creating a compliance burden. And that I think you heard a little bit of that last week from some of the
Mansion House was right.
Some of the trade bodies. But we recognised, and that's also why we wanted to invest in significantly in our data and tech to be able to spot these things proactively. But you're right, we can't stop everything. If we're going to allow more risk into the system, there's going to be, sadly, in the financial services industry, not just here but around the world, it sometimes does attract people who don't have the best of intentions, and we're not going to be able to stop everything. The way through this, I think, and what we try to do at the start of the current strategy, which is coming to an end, our 3-year strategy, is to set metrics, outcome metrics. We, for example, on financial crime and economic crime, the government has an economic crime plan. The previous government had an economic crime plan. I'm sure this current government will update it shortly. And that set overall metrics for where they wanted to get to on the overall level of economic crime. And the answer wasn't zero. The answer was we wanted a certain amount of reduction, and we are then contributing to that overall metric, and we should be held accountable for how much we contribute. That doesn't mean that we're going to stop everything there. Yeah. So, for example, on the unregulated space, we issue several thousand public warnings a year about situations where we see unregulated firms, sometimes firms from overseas, seeking to target UK consumers. It is simply not feasible for us to prosecute that many cases, nor will the courts be able to cope with it. We have to prioritise our resources. We have judgments around what we think is most harmful or where we think the harm might hit soonest, and we go after those cases. Not all of those judgments are going to be perfect or right, but I think, again, taking you through how we make those prioritisation choices, those resource choices, and then hopefully a degree of acceptance that you're not going to stop everything, will help us move the debate forward. And then finally, in areas like crypto, again, Parliament has not banned it, and I know this has been something that this committee looked at. Dame Harriet looked at it a lot in the last Parliament. We have been very clear all the way through. Yep. Anyone who puts their money in these products must be ready to lose everything. And compensation should not and will not be available.
You were very clear at the FT last week.
Can I just sort of move on from that? Because I want to come to Mr. Alder's speech where he set out this, cash, which you mentioned in your opening remarks, around the default to cash savings and consumer readiness to take on risk. Now, arguably what's happened, because we don't have the advice guidance boundary in the right place, we don't have a comfortable position where consumers can put money into equities, and banks and financial institutions aren't ready to set up those. They then go on to TikTok, as we discussed last week, and take extraordinary risks with things that are, as Mr. Rathi has just said, where you put warnings out. So it's pretty urgent that we get a better public understanding of both the risk of just putting it in cash to the consumer well-being further on, but how do we get to a place where our banks and financial services providers feel comfortable marketing products with a high level of risk and non-dependence on cash to actually, for the good of the economy that the Chancellor is setting out at Mansion House, but also for the good of the consumer's well-being? How do we get to that point, and what's the time scale and mechanism for that to happen? Because it seems to me it's the priority of the government, it's a priority for consumer well-being too.
Yeah, so shall I
Mr. Alder.
So, very good question. I think, as just a preface, I think the discussion about risk needs to evolve, because I don't think there's a sufficient discussion about the varieties of risk or the buckets of risk we're actually talking about, and within each bucket, who bears the risk. There's a second point as well, which I think Nikhil quite rightly was talking about, aspects of risk, which often feature in discussions about the FCA, which is fundamentally firm failure.
Yeah.
That's a very different, again, type of risk to investment risk. And I think what your question is really around investment risk and how that features within the overall sort of policy development. Now, I think I mentioned earlier on the kind of demand side of capital mobilization and similar. I can't give you a time scale, frankly, because there are a number of interlocking pieces. At the very basic level, there's a question of financial literacy and financial education in the UK, which is, there's a lot to be done.
And culture?
And we are fully aware of that. We're not obviously the only organisation which is involved. In fact, we're not the principal organisation involved in that area, but it's fantastically important.
I mean, Mr. Alder, you worked in Hong Kong, and the culture's bit. Do you want to perhaps spell out the difference of attitude there to here?
Or what's in between?
Maybe.
I think very, very different cultural background, and a population that, by and large, was extremely attuned to the risks and characteristics of direct equity investment.
Very different.
Very, very different to the UK. Not least because there's relatively little direct exposure now. But I think just in terms of the sort of building blocks, which would includes consumer duty, which we might get back get to, reforming regulation so that we're able, or pursuing reforms that create the tools that the public, retail investors, need in order to have access to the information necessary to take responsible risk-taking. And incidentally, risk-taking is not outlandish risks. This is about participation in equity markets and similar. So giving the population those tools is incredibly important. So the new style of targeted support, for example, under between regulated advice or current regulated advice, or that style, and guidance is really, really important. How the consumer duty enables firms to communicate a lot better with their customers, including prompts to take action in their interests. That's part of it. Consumer composite investments, that's effectively the replacement of the PRIPS regime. That's a huge opportunity across the ecosystem to ensure that, again, consumers have useful informational tools in which to make decisions.
So just for the wider benefit, would you like to explain that the PRIPS regime was deficient in that it was a set of rules that nobody used in terms of obligating firms to produce key information documents that nobody found meaningful?
Yeah, or the information was not useful because illustrations weren't particularly useful to decision making. So the reform of that for the UK is incredibly important. And that package of measures to provide the tools, including, as I say, I'll just come back to consumer duty aspects, that consumers need to think about investment. And I'll just make one important point here. There may be a conflation between an objective to mobilise domestic savings, whether pension or otherwise, in order to invest in UK enterprise. Now, that objective is fine in itself, but we must not conflate that with the principal objective to ensure that consumers have the tools available to them and the opportunities to ensure that whole-of-life financial returns are better than we can see now. And that's really about later life sustainability, the pension system, etc. So that, provided that is seen as the single most important objective, the fact that the mobilisation of savings can then direct some additional capital into UK enterprise through the shop window of listing rules reform and such like. That's really the objective. But it's a set of interlocking measures.
That's really helpful. Can I just ask one final question, Chair? And get back to Mr. Rathi. In terms of the way that the FCA operates, in terms of approving of firms, you talked in your opening remarks about the authorisation and risks associated with it. If we take another model, we're always trying to find out where internationally we should look to. Broadly, if you go to the SEC, they will approve somebody very quickly, but tell them 6 months further down the line, we're going to come after you and review everything. Now, I think broadly here what we do is we go through a much longer process of verification before we approve somebody. Now, international financiers and people in the markets would say, that is a frustration. Have you ever sort of fundamentally thought about, do we do it the right way round? Would we be doing it better if we approve things more quickly but came down very hard and people knew that? And would that be a better sort of stimulus for getting more activity in London and in our markets?
Mr. Rathi.
I know some people make comparisons to the US because certainly on the wholesale financial market it is the major competitor for us and is our biggest trading partner. The SEC obviously doesn't have a consumer protection objective. They have an investor protection objective. There's a separate consumer financial protection bureau. And they do have a system which relies on litigation, an adversarial system in the courts, much more than we do. And I think when we think about competitiveness in the UK, one thing we do hear from firms is actually we wouldn't want to move down towards a class action, very litigious, very expensive approach, because while you may have a few more compliance people in the UK, you don't have anything like the armies of lawyers that you would need when you operate in the United States. And then going back to the case you raised, one thing we saw was if we miss things at the authorisation gateway, the potential for harm is very significant. We it takes a long time to get a non-cooperative firm out of the regulatory perimeter once they're in, because we have to follow a whole series of legal steps to do that, and that can take a number of years. So I think, and then finally on authorisations, I think we publish the data, quarterly now. The well-documented applications move pretty quickly through the system now, often within 25 to 30 days. So we have to keep improving there. We're digitising there, but I wouldn't move to completely allow everything in and then try and get it out afterwards.
Thank you. That's very helpful. Thank you. Iwan.
Thank you, Chair. Mr. Alder, I wanted to ask a bit more about the appropriate level of participation for retail investors. And in your previous speech, you mentioned that the different investment culture in Hong Kong you saw was one of much higher retail participation than in the UK, and people being much more aware of the market and the risks involved. I suppose the converse of that is across the strait in mainland China, the regulators there would talk about how their high level of retail participation poses risks because of the level of, for example, financial influences, kind of bandwagon jumping, and the fact that lots of household investors are not very protected and may not be aware of the level of risk they're taking on. So there's a different kind of, they may be at a different part of that spectrum. So my question is for the UK and for the level of literacy and sophistication of retail investors right now, what is the appropriate level of participation and how do you gauge that?
Yeah, well, it's a really good question, and I recognise your description of Hong Kong, mainland China, very heavy retail participation in mainland China stock markets brings its own issues with it, particularly around expectations of returns, which may not be realised in practice. I think in the UK, it kind of comes back to the answer I gave earlier, is that certainly not we or anybody else I think is after is sort of an atmosphere of unrestricted risk-taking for retail. That is why the tools that we have in mind, or which are now progressing, which are, I think, have been also fairly well discussed with the government and with the public at large and firms, those tools are absolutely critical to enable those retail investors who currently may not be investing to have the best of information available to them, or the right information available to them, in order to make responsible decisions. I go back to the remit letter that the Chancellor wrote to us, informed and responsible risk-taking. So that really is something I think we would agree with as a principle. The question is, how do you do it? So that is why, it sounds technical, but the advice, guidance, boundary work we're doing, in my view, not alone, but is really, really important. Secondly, consumer duty, just coming back to consumer duty, that's fundamentally about making sure that the sort of products, financial products, that are offered to retail investors and savers, including credit products, are the products that are needed at the right time for retail investors and others. So as part of the sort of complex of the regulatory framework that informs the way in which retail may behave and the options available to them, it's a combination of consumer duty, informational regulations and similar.
When you think about the groups of people who are ready, or for whom it might be appropriate to take on more risk, do you have certain demographics or parts of the population in mind? For example, when you talk about equities investment, it brings to mind those who have enough of a lifespan to enjoy the long-term holdings of those investments. So I was wondering if there's any demographics or any particular subgroups you think would most benefit from this.
If I just give you some data, so we run a financial life survey every couple of years to try and get a sense of how people are planning for their financial well-being. And I would talk about engagement and participation. We've got two problems. One is people are not engaged in their long-term financial well-being, even before you decide how much risk you're taking. So our latest Financial Life Survey says 75% of defined contribution pension holders over the age of 45 do not have a clear plan for saving for their retirement. Before they even decide whether it's equities or bonds or anything else, they just don't have a plan. 97% of people who are auto-enrolled into pensions are just in the default fund. So they've just gone straight to default. Now, auto-enrollment's been a real success story, but people aren't engaging with what their money is invested in. Clearly, the younger you are, the longer life sort of horizon, time span you can think about, and you should be able to take more risk at a younger age with the modest pension savings or long-term savings that you make. But then there are also other pressures, whether it's saving for a home or rent or other things. And clearly, later in life, there probably needs to be a degree of rebalancing. But the decisions will be, to an extent, based on people's different circumstances, because it depends on what other savings wealth they have. So they need to think about everything in the round. One of the things we're doing with targeted support, and a paper will be coming out very soon, later this week, on how we can incentivise the use of targeted support in pensions advice, is moving away from saying that every time you give advice it has to be optimised for your personal circumstances. Because one of the things we're worried about is the cost of that has become prohibitive for people to access that advice. So what we'll start to say is, people like you, this might be the right thing for you to do.
Guidance.
Yeah, but that does mean, and this is again the point about risk, Chair, not everyone's going to get the perfect piece of advice if we allow that in, but we do think the mass market might get a much better outcome, even if everybody isn't getting something completely optimised. So again, we would like, the government is very engaged on that. We would like a good risk discussion with you as to if that's acceptable to you as Parliament as well.
And that comes into just the first phase of a new style of advice. The people like you aspect is particularly directed to that critical decision about pension decumulation. So the point at which you have that choice, do the population currently, or those making that choice, have available to them the advice resources that is affordable? And the answer to that is no, right now. So the project effectively is around both commercially viable but affordable advice in order to help those making decisions around, in particular, in the first phase, decumulation decisions.
Just one last question on, you mentioned before the need for financial education and literacy, and I was wondering if that is part of a discussion the FCA is having more broadly within the government about how to start to include that in schools and in school curricula.
I addressed this in a speech I did at the charity Step Change in Leeds in September on financial inclusion, also how critical financial inclusion is to growth and competitiveness. And I think there's an important connection there to make. There's two issues. One is around numeracy and one is around financial education. So if we look at school leavers just this summer, 40% of school leavers in the UK didn't get a full pass in GCSE maths. And then you look into the workplace and even look at the data on how many working age adults understand percentages, understand an APR, understand what a percentage for a loan or credit card is. It's concerning. So when people say, we should be compared to Singapore, well, their equivalent is something like 92% got a pass. So it's a very different starting point. And then there is the broader question around financial education and financial products and understanding that at a younger age and how you handle money. There is a curriculum review underway. The Education Select Committee in the last Parliament did a really good report around this, and they made a recommendation that financial education should make its way into the curriculum, and we can certainly see the benefits of that. Although when I talk to my colleagues in the Department of Education or elsewhere, obviously they have a lot of pressures on teachers, have a lot of pressures on them to tackle a lot of things. So you have to train the teachers, and then you have enough teachers and have the resources to be able to do this effectively. So I understand that there are some hard choices there for the government.
Thank you, Vinal Rajan. Chris, MP.
Thank you. Mr. Rathi, I think you make an excellent point around financial education and getting it in the curriculum. I'm wondering if we're overcomplicating this, though, because from my perspective, with financial literacy, you look at equities on any 15-year period over the last 120 years, they've outperformed pretty much every single other investment class, and you've made a fantastic return. The issue with that, of course, is that within any 1 year period, you could have lost 30% of your money. But investing in the index is generally outperforms pretty much everything else. You don't need sophisticated financial products in order to achieve that. And then many financial advisors obviously advise, you should invest your age as a percentage you invest in bonds and the rest in equities. But that, in essence, is what a huge amount of financial advice boils down to. So it sounds really complicated what you're saying in terms of the issues around financial literacy and everything else. But I'm slightly struggling to understand where the issue is here. I mean, is it just a question of too many complicated financial products out there in the market? Is it a question of that most people, they use online banking, the high street banks are not offering simple equity products as part of that, so there's a convenience issue, and what is the role of the regulator within this? But I personally am struggling to understand why it's so difficult to show people that there's an attractive investment class for their long-term retirement out there. It's actually quite simple how you invest in equities, provided you're willing to accept the fact that you may lose a significant portion of your money in any 1 year, but provided you buy and hold, you should make that back.
Mr. Rathi.
If I take the United States, I think around 38% of households in the United States own direct equities. Yeah. We have about 11% to 12%. So there's a huge cultural difference there. And you have a culture in the UK of people managing what they call their 401k plans, and that is their long-term savings vehicle. We have, I think Barclays produced a report on this, so I'm using the stats from sort of recollection. They estimate around £450 billion is in cash in the UK, probably in low interest or no interest accounts. Now, some of that will be needed for liquidity and transaction purposes, but a lot of people are holding these large amounts of cash, which during a period of high inflation was inflating away in value and missing out on real returns in markets or in other asset classes. And so I would say that risk aversion that's there, that anxiety that exists, the understanding is, it may feel simple, but it's not. Yeah. It isn't so straightforward. And we also have a world now where what we track in the UK, in the FCA, because we obviously oversee the wholesale markets too, is the scale of volatility. So we look at 4 to 5 standard deviation moves, where there's been a very big move in markets. The number of those moves has multiplied in the last few years. So if I just go back to August this year, the Nikkei index in Japan fell 12% in one day, the second largest fall since 1987, Black Monday 1987. And you have these very sharp moves, and the tech stocks in the US can sometimes fall by the scale of close to half of Ireland's GDP in an afternoon. So consumers need to be really resilient to when you go online and look at your portal, you could suddenly see some of your portfolio has gone by 10 or 15%, and that can be quite life-changing for people. So saying to people at that point, you've got to take a 10 or 15-year view, requires a sort of a different perspective than what might naturally, what might come naturally to people. So I think that is part of the conundrum we face. And then finally, we have seen growth in markets beyond equities. So infrastructure as an asset class, private markets as an asset class, and you're seeing that move into retail in other jurisdictions around the world. We've started to our long-term asset funds.
You've got big liquidity issues with that.
Liquidity issues, but also where you see some quite strong returns over a longer time horizon too. So there's a range of choices, and that's why people need some support and guidance, I think, to be able to navigate what might be appropriate and right from that. That's before we even get into the debate about is it UK or is it global.
Yeah, and how do you, is there a big risk that, or how do you prevent the FCA becoming liable if you start urging people to take more risk and then they lose 30% of their money next year? Is that a risk for the FCA? Or?
Absolutely, which is and it's good that we're having this discussion. I think the Chancellor's letter is the first time I've seen a minister put in writing what she did, which is that the government's position is that to deliver growth there needs to be more responsible risk-taking in society, and the government recognises some things might not work out and they will stand behind the regulatory system when that happens. and allow the mechanisms in place to work. And I think it's important that we have that discussion with this committee as well, because I think we will never be able to prevent those kinds of market moves or those kinds of losses when they come.
Yeah, exactly. Yeah, I mean, it seems an education piece that's needed. Just last one, Mr. Alder, just coming. With this lazy capital, you were saying we should put it to more productive use, and there's a tension between whether that's boosting UK investment versus internationally. Because if you just look at, obviously, the FTSE 100's significantly underperformed over the last 5 years or so. How do you resolve that tension, or essentially for you, or trying to get pension funds to invest more in the UK when they're actually, it looks like there are better returns elsewhere, and what's the role of the regulator with that?
Yeah, and it is tension. I think you can see the debates about the Mansion House Compact from last year, which is really firms or asset managers, signing up to voluntarily invest a proportion in the UK. It is difficult because, again, there's a fiduciary responsibility, not least in trust-based pension schemes, and the trustees are certainly having a conversation about how they intersect with a government ambition to mobilise capital for UK investment. I think our stance at the moment as a regulator is that we fully recognise the need to broaden the availability of businesses in which to invest. And I mentioned that earlier in the context of kind of the supply side, PICEs, listing rule reforms, etc. And I think we fully recognise that, for example, a prompt, this comes under the sort of value for money framework, to pension funds, assuming that they will consolidate, which is certainly the policy, the prompt to move away from a focus on cost to returns, effectively is saying, in order to do that, you invest across a broader risk spectrum. You don't go all in on illiquids, but certainly they could be a proportion of what you invest in. And we've seen, I think the government's pointed to the examples in Australia and Canada in particular, not simply Australia, there are others as well, where you have effectively very, very large funds who actually invest globally and domestically across a broader risk spectrum. So I think where we are at the moment in this debate is what is the set of tools on both the supply side, firms getting into the shop window, and the demand side, mobilisation of capital, particularly around pensions, but also empowering investors, effectively empowering retail to allocate to an extent, but with, it sounds trite, but with the right sort of advice and the right sort of information around this. And incidentally, in relation to financial education, there's a great deal to be said around consumer credit, because I think financial education isn't simply around invest in a tracker and then over the long term that's best for you. There's a big discussion around money management in the context of credit for a very large section of the population.
Fair point made. Thank you very much for now, Mr. Coughlin. Rachel Blake MP.
Thank you, Chair. We had the sector in last week alongside consumers, and I was struck by some of the unity between both the financial services sector and the consumers. So Miles Chelik said, a successful market is based on trust and confidence. A critical element of that is consumers being confident in that market, so I do not see it as weakening customer protections. And then we had Helen Charlton saying, to reinforce the point that was just made, we must remember that trust in the financial services sector is low. The FCA's own Financial Live survey says that only 41% of UK adults have confidence in the UK financial services sector, and 36% disagreed that financial firms are honest and transparent. The FCA has a difficult role and challenge in terms of balancing both the sector and consumers around overcoming that fundamental trust and confidence mismatch. How do you see your role navigating that at the moment?
When we established a consumer duty at the encouragement of Parliament after some legislation in 2021, we said that one of the metrics of success over the long term, because these things don't come immediately, is can we shift that trust index? And what we were seeking to do by placing very clear expectations around the outcomes we were after, not process outcomes, in terms of reasonable value products sold honestly with good customer service, thinking about vulnerable consumers and their needs as well, and make that a feature of what's discussed in boardrooms when they are signing off strategies, deciding on product manufacturing decisions and distribution and pricing decisions. Over time, we want to see that. We see that as our way of contributing to the improvement in some of the mechanisms that you talked about, and we do think that should also enable us to streamline our rule book. We've just closed a consultation which the industry welcomed around how we could streamline our rule book. It has to be done carefully and thoughtfully and paced properly in the next year or so that we can take out duplicative regulation as we move to outcomes-based regulation. And it will also give us the agility, we think, to be able to cope with new technology as well. So artificial intelligence is coming. It can offer huge benefits to consumer markets, huge benefits to consumer markets. There are risks as well, so let's be clear-eyed about that. But we're not going to be able to write regulation for every new technology that comes. These things are moving very fast, and we think an outcomes-based approach, where we say to firms, go and innovate. You've got the senior managers regime in the UK where you have clear governance, and these are the outcomes you're expected to deliver. Will also help us move the dial as well.
Thank you. Ms. Blake.
Where there was less certainty from the sector was around exactly how they would like to see regulation change in order to enable the secondary objective. So we asked them, what is it exactly you'd like to see change, which regulations, and they were less clear on that. Do you have clarity around, you've talked about the rule book in your letter, you've talked around Pisces, which you've mentioned this morning, and also pensions reform. Is that the totality of the changes that you might make towards the secondary objective?
We've undertaken a range of changes already. We produced the first report on the secondary objective and published that in the summer, and we'll do another report in summer next year. Ashley talked about the capital markets reforms. We're in the process of reforming the prospectus rules, and the nature of the range of interests that exist in the sector that we regulate is it's you get very diverse views, and sometimes you hear about this risk trade-off, and are we risk averse? If I take an example of the prospectus regulation reform, where we're proposing something quite far-reaching, which is to say an existing listed company should be able to raise share capital of up to 75% of their issued share capital. That's a rise of nearly tripling what it is today. The investors are comfortable with it, but the sell-side banks are quite cautious about it because they're very worried about the legal liability that might fall on them if they're underwriting these issuances. So there's tensions within the sector about what the risk approach of the FCA and the regulation should be. But that's another example. We're doing a huge amount on the wholesale markets in terms of our fixed income markets, commodities markets, revising MiFID. That gets less attention, I think, in some of these discussions, but it's key to the operating of the wholesale markets. We're rationalising the rules around insurance distribution for commercial insurance products as well. So there's a big programme of work. What has been hard to pin down, I think, and I'm glad we did put out the call for input on consumer regulation. I mean, there is a real mix of views that's come through. I mean, from small and large firm, different sectors, about pace, about content, about risk you should take. And we are now going to try and work through that, surface that with you as well, and try and land on a few priorities as to where to move forward.
So to help you work through that, is there anything more that you are expecting from the Chancellor that would help you work through that range of opinions from the sector towards delivering on the secondary objective?
I think it's very important when we think about the growth and competitiveness objective to focus on the evidence, because I think sometimes you can get into conversations where if there's any part of the industry that's unhappy with something, that somehow that's anti-competitiveness. And life is not as simple as that at the FCA in terms of the range of interests and representations we receive. I think it is being clear that we need to look at what the evidence is telling us, and we're doing some academic work on that as well. And then the next point is the risk appetite point. So, for example, we have had representations in this consultation on adjusting disclosures. Disclosures for sale of mortgage products, disclosures for sale of other financial products, because they think that consumers don't engage with it, it's burdensome, they can move their digital processes faster. And there's some force in that argument. But that will also mean, if we do streamline that, it's not going to work out perfectly for every consumer. And so what we need from the Chancellor, what we need from Parliament is if we move in that direction, and we'll do all this through consultation, so this won't come just immediately, there'll be a time to engage and discuss, and there's now a formal role for this committee, as you're notified about consultations, is a discussion around that, and then an acceptance that if we do move in that direction, we're all on the same page.
Yeah, so you're not the Fall Guys.
Well, it's not so much that. I think it's more that there are tensions and debates here, and you will get this in your mailbags. So I entirely understand the sentiment that comes through the committee to us, but then we're also asked quite regularly to streamline the rule book. So there's some choices there.
That's what Mr. Commons.
Yeah, just building briefly on the point that Ms. Blake made around lack of trust. I think perhaps one of the reasons for that is the fear of firm failure that you mentioned earlier. Is there more that needs to be done in terms of protecting consumers' investments and money in the event of firm failure, in terms of investment firms' failure, or more that you could do to reassure consumers that if a firm fails, it doesn't mean they lose their underlying investments?
Again, I think I actually touched on this. He talked about investment risk and firm failure risk. I think there are certain investments where we just have to be clear. These are high risk, and if you put your money here, you lose. Crypto's one.
So I'm talking about the failure of the fund manager, for example.
Yeah, but Mr. Glenn asked me about the authorisations gateway. So we did not allow FTX into the UK authorisation gateway. Now, that was in the context of a government that was very pro-crypto. So it wasn't easy. These decisions of us refusing these firms was not easy for us, but they just didn't meet money laundering standards in the UK. Now they went, and it was potentially one of the largest failures in US corporate history. They went over to the US, and the DOJ there said potentially one of the largest criminal frauds they've ever seen. And so in that case, firm failure, it didn't happen here, but if it had happened here, I think we'd have to say, consumers, I'm sorry, if you're putting money into crypto, these are very, very high risk situations, and you need to put money in that you afford to lose. We have quite elaborate systems in terms of the FSCS, probably more generous actually than comparable jurisdictions in Europe or elsewhere. There's now a debate around those areas which are not covered by the FSCS, but the sort of safeguarding regime, and that comes in payments in particular. And there is a tension here, because this has been one area where people have wanted innovation and allow new small firms in, and this is a big fintech growth area. So don't go too heavy because on audit requirements and control requirements. But it's also an area where we have seen the most consumer harm when firms have failed.
Isn't there an asymmetry between the new firms and the old firms? How do you get the regulation right? Some of the fintechs would say they've got better systems that don't necessitate the same degree of regulation as some of the older firms, and there's a tension between them. How do you reconcile that?
I would say that we have got an earlier high growth oversight scheme, which has got 400 firms in, where we put tailored support around the smaller, fast-growing firms to help them scale. Some of them do have better systems. Some of them, though, grow so fast that their systems can't keep up. And that can be a bit of a tension with these fast-growing firms, because they feel they want to shoot for the skies, and we're sort of saying, well, yes, but you need to demonstrate to us that you can protect the market at the same time.
Yet another tension. It seems, Mr. Rathi, our job is just lots of tensions to manage. Thank you. Mr. Bobby Dean, MP.
Thank you. This conversation around the British public's confidence in the financial industry, I know that some of it is based on financial education and other bits would be around people's inherent risk appetites, but some of it is just fundamentally trust whether the financial products that are being served by the industry are things that they can trust. So we've had the PPI scandal, and we're now talking about potentially the issues relating to motor finance as well. I've been told by one firm that there could be up to 1,600 claimants in my constituency alone, so the scale of this is potentially huge. And I don't know if this is a question for you, Mr. Braviner Roman, but we tried to get a sense of the scale, potential cost and timeframes from industry last week and didn't get it. Could you provide us with more clarity?
Certainly. So just taking a step back for a moment, before attempting to answer that question, what's gone on in relation to commissions in the motor finance industry is a situation that's been developing over a period of time. We first started looking intensely at it back in 2017. We did some work which led to a ban of a particular type of commission arrangement called discretionary commission arrangements in 21, and a re-emphasising, a doubling down, if you will, on some of the transparency requirements around commission arrangements generally. Since 21, we've seen a growth in complaints and in counter-court actions in relation to commission arrangements, in particular in relation to those discretionary commission arrangements, hundreds of thousands of complaints. So the figures that you give in relation to your constituency are entirely believable. As a result of those growing numbers of complaints, we intervened to take action, and we can talk about the action that we've taken in relation to discretionary commission arrangements, because we could see a developing situation that was going to lead to potentially a disorderly, inefficient, unfair redress situation, both for consumers and for firms and for the functioning of the market. So we saw that developing. What's happened with the Court of Appeal case, which has prompted the latest discussion about the numbers, is that that's brought into focus a different type of commission arrangement. They're often used in conjunction, so the same individual consumer will often pay commission that is both a discretionary commission arrangement of the sort that I described and a fixed commission. So the commission arrangements often are wrapped up together, but sometimes they're separate. So the scale of the problem that we were anticipating and we were investigating with our intervention in relation to discretionary commission arrangements has undoubtedly expanded with the Court of Appeal decision. The Court of Appeal decision is obviously subject to appeal at the moment, so we don't know whether that is going to be the final word exactly on the parameters of that ruling. The work we've done in relation to the discretionary commission arrangements, we've paused complaints, we've done a lot of work working with firms to understand the scale of the issue. We were anticipating coming back with the results of that work and explaining to people where we'd got to in May of the coming year. We now need to take stock of the scale of that problem in light of the Court of Appeal decision, do some further analysis looking at the wider, what the implications of that could be. So we are working at that. We are not in a position, it's premature really to say it will be a particular scale. We've previously said, and Nikhil in fact has previously said, that looking at DCAs alone, we do not think it's the scale of PPI. But that was when we were looking at DCAs alone, so I think it would be premature to say it's definitely not the scale of PPI.
If I could just, let's pause on the Court of Appeal bit for a moment,
Yeah.
We'll come back to that. Specifically in relation to the DCA, obviously taking the decision to do that long pause, and that pause looks set to be extended. What should claimants do in the meanwhile? And can you explain to us what preparation you've got in place already for moving on this next year? And in particular, there are some claimants who say that they're better off going via the court system. They'll end up with better outcomes for themselves in terms of compensation, but that this pause is going to possibly time out many cases as a result. Could you provide reaction to that as well?
So just on one tiny factual, you suggested we were extending the pause. That begins, I think, to conflate the Court of Appeal and our response in relation to fixed commissions and the discretionary commissions. But so let's just stick with discretionary commissions where we have a pause. Pause is a slight misnomer of language as well. We often talk about it as a pause. Actually, what we've done is given firms a longer period of time in which to deal with complaints. Normally, if you complain to the firm, it doesn't deal with it within 8 weeks, or it deals with it and you're unhappy, you have the right to take your complaint to the Financial Ombudsman Service within that period. We've extended the period of time within which firms can deal with things. We've done that because we think that the sort of converse situation where we have hundreds of thousands of complaints running through firms, running through the Financial Ombudsman Service, is not going to deliver quicker or better outcomes for firms or for consumers. It will overtip both firms in terms of the administrative burden, will overtip the Financial Ombudsman Service in terms of administrative burden, that scale of caseload to deal with. Itself brings additional cost that the firms would have to pay, which is, if there's redress to be paid, would be better in the pockets of consumers rather than being swallowed up in the administration of the system itself. So we don't think that the pause or the extension time delays, in truth, people getting a proper redress. In fact, it ensures that people get the redress they're more likely to be entitled to in an orderly fashion.
Can I just push you on the courts point, though? Because I had some comparisons here about the level of compensation that you can get via going through the FCA and then the FOS and then via the courts, and it's more than double each time. And there is this big fear that with this long period of time that firms have been given able to respond by, that many court case opportunities will be timed out. What would you advise to those people who fear that? Well,
the court cases, we can't control the courts. So the FCA, you hear a lot about the powers of the FCA. That's one of the powers we don't have. Yeah, exactly. Yeah. So you heard it here first. So nothing that we've done in relation to complaints firms having longer to deal with a complaint has anything to do with an individual's legal entitlement to take a claim to the county court. They can bring that claim today, tomorrow, whenever they're entitled to do so. Claims that go to the county court would be timed out if they're outside a limitation period. Without getting too much into the details of how the limitation period works, normally it would be 6 years. But in many of these cases, part of the underlying factual premise is that there's been concealment of one sort or another, depending on the scale and the precise facts. But if there's a case of concealment, generally speaking, time doesn't run until you know of the facts. So if a consumer had... The
clock doesn't start ticking until...
Yeah, exactly. If a consumer doesn't know they've got a secret commission in their case, the clock will not have started running. If a consumer's put in a DSAR request to a firm, as many thousands have, and knows that they had a commission arrangement, the clock will have started running. So our extension to the firms doesn't affect the time limits that individuals have in order to bring a claim in the courts, doesn't affect the court's ability to deal with it. What is happening in the court system, which mirrors what we've done in DCAs, is actually many county courts are pausing, or staying in the language of the court system, individual cases in order to have a settled position of the law from the Court of Appeal, and now pending the decision from the Supreme Court.
Final question. Yeah, I know others want to come in on this, but Mr. Rathi, to you. We spoke a bit earlier about risk and need to become more comfortable with it, and sometimes firms will fail, and that might be a risky investment, and sometimes you might lose money for other reasons too. But in these particular cases, is this not something that a consumer shouldn't have to face? I mean, on this scale, is this not more reflective of a culture within financial services that attempts to come up with schemes that the consumer don't fully understand in order to widen their profit margin?
So we took the decision to ban discretionary commission arrangements in 2021 after a market study and some consultation, because we felt there was consumer harm in that market. So using the banning power is quite a strong power to use.
Sorry, if I could just come in. should firms not have already known this, though, that this was not a good activity to be undertaking?
Yeah.
So we came to that view on discretionary commissions in 2021. I think what I'd say about fixed commissions is what we're seeing here is the complexity of the legal landscape in the UK, because you have regulation. Overlaying us is the Consumer Credit Act, which is passed by Parliament, and the Treasury started a review of that in 2022. And then what the Court of Appeal has done, and Stephen's the legal expert here, is then gone back to common law to come to a view on fixed commissions. They did that with cases in the county courts coming to a conflicting view as to what was legal and what was not legal. So this was a disputed area of the underlying law. So that is what this process on fixed commissions is intended to establish, going potentially to the Supreme Court to understand what is the settled position in statute on what is allowed and what is not allowed. I think that is different to the practice on discretionary commissions, where we were very clear that we felt there was significant harm, which is why we took the step to ban it.
Before that point, was the FCA not alert enough to it sooner enough, or were firms behaving badly and kind of
fixed commissions?
Yeah. No, on the DCAs. Prior to your judgment.
So on DCAs, so the consumer credit portfolio, which was about 20,000 firms, came to the FCA in 2014 from the Office of Fair Trading. And so there was a big job at that point. I think it was one of the biggest transitions of regulation we've seen in a number of years. This is obviously before all of our times, but I think the focus in those first couple of years after 2014 was to get that portfolio firm settled in. Then there was some work around discretionary commissions in 2017, a market study, which led to the proposals around taking action there in 2019. Now that all got paused because of COVID, and there was a period where the organisation was not focusing on new regulation; it was focusing on keeping the system going in 2020. But then when we came through that in 2021, we went forward with the ban. So that's the course of events and the timetable there. But Stephen, if you want to add anything?
No. That's
Okay, Mr. John Glenn.
Yeah. Could I just follow up on that question, Mr. Rathi? On you've helpfully explained how this area of regulation came under your purview, essentially, and this goes to a more fundamental question about governments, like with funeral plans, giving you another responsibility. It leads to the point where you've got 4,800, 5,000 people under your authority. How do we? Is that viable in terms of public confidence? Because what we've got here is a situation of confused accountabilities. And you have an evolving set of responsibilities given to you by various governments over time. Do you ever think more fundamentally, notwithstanding the transformation programme you've undertaken over the last 3 years, about the optimal organisation between consumer and wholesale regulation, and whether the FCA in this evolving space actually gets things right in the terms of how can it get it right when you've been asked to do so much? I suppose I'm asking, does this experience prompt you to ask more fundamental questions?
I think one of the things about the FCA is that those fundamental questions are always being asked, and the debate never really stops. And I was asked about this in my pre-appointment hearing, and ultimately the view I take on these is that the structure of the regulation and the remit of regulators is a matter for government and Parliament. It's our job, once you've given us the job to do, to put the organisation infrastructure in place,
that's all right to a
the
point.
Data and technology to make it happen.
You're the longest serving chief executive of the FCA. You've gone through a massive transformation programme where you were trying to empower decision making further down your organisation. You must have an instinct, because we as politicians want you to succeed, and we want the economy and the financial services industry to be in a better place. I mean, this goes to the heart of how you can be effective. And I'm trying to draw out from you your best instincts to advise Parliament and government about where we could do it better, or get you to do it better.
Yeah, so, I don't think the remit is unmanageable, which is what some say. And then obviously there's always the debate around wholesale and retail, and I think different structures have been tried in different at different times. The US has a separate consumer bureau, which isn't particularly popular with the industry over there, and they have multiple agencies, and it's quite a complicated landscape. I think that the most important thing is what we've been talking about, which is getting alignment on what is the strategic direction, what is the risk appetite across wholesale and retail markets. There's debate within wholesale markets, there's debate within retail markets, and indeed there are many markets where the boundaries are blurring. If I think about payments, if I think about crypto, if I think about even what we talk about long-term asset funds, we started off in the institutional market, going to DC pension funds, but we're now opening it up to retail. If I think about institutions, let's take Barclays, for example, it's both a wholesale institution and a retail institution. It's not hugely convenient for them to have multiple supervisors. As one example, it's not necessarily going to lead to a more efficient system. What we perhaps have struggled with is that real strategic alignment, which is time consistent, which lasts over a number of years. Because as you say, when one of these things appears, it can kind of shift the debate. The perimeter is always going to evolve. You know, we have a very sophisticated financial services industry. New products are coming, whether it's funeral plans, whether it's buy now, pay later, whether it's crypto, whether it's alternative vehicles. So the key from my perspective is just getting the infrastructure in place so that we can bring these into the perimeter using data and technology much more effectively. But then also acceptance, I think, which is what often happens. The process to bring things into the perimeter, funeral plans you'll be familiar with because you were the minister. It took years. From when the issue was first surfaced with you, by the time the debate happened, we can't take responsibility for the harm that's done before the authorisation gateway. And I think what happens is, and in Buy Now, Pay Later, I can tell you straightforwardly, we've taken action. You can read it in the press. There's all kinds of harm out there in the way debt collection is working, bailiffs are being called. That is not arriving in our perimeter till 2026.
Okay. Well, we'll come back to some of the other areas. I think if I go back to Mr. Dean next.
Yes, Mr. Braviner, I was struck by you explaining about the burden on firms of these customer complaints, and we've also got at the same time consultation going on about reform of financial ombudsman services. Do you think that these reforms have been prompted by the burden on firms, and does it still have the sort of rights of consumer in mind?
The call for input on how we deal with mass redress wasn't. It was obviously predated the Court of Appeal decision. It wasn't prompted by that, but it was prompted by a reflection as to how the system works for a singleton complainant, which, broadly speaking, works pretty well. In the sense of, I have a complaint with a firm, it's related to my particular circumstances, the firm can deal with it or not, and if there's a dispute, can go to the financial ombudsman, they can deal with that on its individual merits. What the system isn't structured to cope with as well are mass complaints, are 100,000, 200,000, 2 million people, all with very similar complaints, coming in at different times, landing in different firms, being dealt with inevitably slightly differently by different firms coming into the Ombudsman Service. The Ombudsman Service isn't one ombudsman, as I'm sure you appreciate. It's a range of individual ombudsmen who make individual decisions on the facts before them. And their jurisdiction, although it's very broad in terms of they are required to find, come up with what they think is a fair and reasonable outcome, it's dealing with a fair and reasonable outcome with that consumer and that firm in that circumstance. And what they're not entitled to do is to step back and say, oh, but this is one of 2 million complaints or one of 200,000 complaints. If I determine this way, what does that do to the industry? What does that do to the consumers of the future? What does that mean for the consumers of the past? Those questions are not before the ombudsman. All the ombudsman's thinking about is this consumer, this firm. So as soon as you get into a mass redress situation, the scheme doesn't work entirely satisfactorily to allow the range of factors, the order, the fairness, the equity, the wider considerations that, frankly, only the FCA or the government actually have the jurisdiction, the statutory powers to think about. So that's why the redress scheme is the call for input on the mass redress is out there. It's not just because of firm burden, although that is one aspect of it, but it's more about the system isn't designed really to get fairness for the consumers that you're talking about in an orderly fashion on its current individual decision basis.
What would you say to people who say that the easiest way to ease the burden on firms is to stop these mass redress events happening in the first place, and there needs to be much more proactive prevention of these kinds of incidents in the first place? What would you say to that? Maybe Mr. Rathi.
So I'd say a few things. Well, that's one of the reasons for the consumer duty to enable us to get more proactive and for us to intervene earlier. Secondly, we've been doing a consultation which is looking at our capital requirements for firms such that those who are getting more complaints that are likely to lead to redress, we spot that early and they hold more capital against it. So there's incentives in the system to address those issues. So absolutely, I don't think it's good for the system to have these kinds of events. Some of it goes to the legal complexity I talked about. The other point I would just underline in terms of what Stephen was saying, when we think about consumer protection, and it's a challenging debate to think about ensuring people are treated fairly where there have been issues that have affected a large number of consumers in the past, but making sure that as we construct whatever mechanisms we need to do to deal with that, we also think hard about consumers of the future being served well as well. Because clearly it is not in anybody's interest to not have a motor finance market which serves millions of consumers every year, available to people who use it to secure finance for cars. So again, when Steve was saying who has the remit to be able to think about that, it's us to think widely about it. The FOS will think about individual cases, and then ultimately, of course, the government as well.
I'll bring in Dame Siobhan McDonagh, MP.
Thank you. We've spoken about the lack of faith in the public about the financial industry, and we've spoken about how broad your work is, both on the side of the bank and financial institutions and then the individual consumer. Aren't these two things they cannot be combined in one agency? Because are the FCA more interested in regard to car finance in the long-term interests of the banks or the consumer?
We've said in our documents on this, we are assessing everything against our statutory objectives, which is consumer protection, market integrity, the market's functioning well, which is what you've asked us to look at in the objectives, and competition in the interest of consumers. And as we work through this, we sought to do it as transparently as possible, and we will do that in May as well. We'll lay out the evidence against all of those objectives, and there are tensions between those objectives, and we will surface those tensions. So this isn't about favouring banks over consumers. This is about ensuring the law is complied with, that consumers are treated fairly. But the point I was making earlier, Dame Siobhan, was that it's not just consumers in the past, it's consumers for the future as well. We all have an interest in having a functioning car finance market that works well in the future too. And so there will need to be appropriate judgments made about how you balance all of that. And we'll do that in an evidence-based way and proactively keep the committee informed as we're going, so we can hear your views too.
But you have these two countervailing forces. You have the banks, which are institutions we all rely on. We want them to have good and healthy futures via potentially hundreds of thousands of consumers who are treated badly. And the scepticism as arises that the number has to be big on the consumer side to force any action. And they as individuals are now delayed in making their claims. Can you see how that might undermine confidence in the whole financial market?
I can see...
Because banks do things on occasion which, as a layperson, you cannot understand how they thought that was fair or reasonable.
I can understand the force of the point you're making. obviously the particularly on discretionary commissions, this is pre-2021, and we're hoping certainly with the consumer duty and other steps we've taken that this kind of thing will not happen in the future. But I hear what you're saying there. I'd say that the issues will always be challenging in these mass market type events where you're talking about uncertain interpretations of the law. So some of this was discretionary commission where we were clear about harm. The fixed commission one, the courts have ruled both ways. There are different court rulings which have come up and that's why it's gone to the most senior courts in the country to try to work out what the right legal position is, and we will then take stock once we get there. So that is, and that sometimes these points of legal uncertainty arise, and the system does take time to work through. As Stephen said, we don't control the courts; they have their own timetables.
Sean.
But wouldn't you agree that the banks are wrong to claim that they're being punished retrospectively, given the FCA's framework was clearly had been in place for many years?
Yeah, we don't agree with the retrospective argument here. So the work we were doing on discretionary commissions was not trying to hold them to the 2021 standard for previous activity. It was examining whether they were complying with the law and regulation that was in place at the time before 2021. Yeah. So that's not that argument's used. That's not one which we recognise. And I think you're right to say that if there has been a breach of the law, there will need to be consequences for it. All the firms do have a right to go to court if they disagree with an interpretation of the Financial Ombudsman or another decision. They can challenge it, and one firm has done so. And we'll see what the court says in those cases. The courts are there to protect everybody, not just consumers. They're also there to protect firms as well if they feel there's an unfair judgment. Stephen?
Just to help, if it's helpful, without sort of getting into all the details of the Court of Appeal judgment and the particular cases there, it's certainly true to say that there's certain narratives which some may have articulated or allowed to be said, which is almost paints the position as previously there were no rules in this space and there were no requirements to disclose anything, and the Court of Appeal judgment requires a level of disclosure which is unprecedented. That's an overstatement of the position by some way. The rules that the OFT had in place before 2014 required disclosure. The rules that we've had in place since 2014, prior to the ban that Nikhil referred to, were predicated on the fact that there's a potential for conflict when a commission's been paid, was predicated on the value of transparency. People had to be transparent about commissions if they could influence the decision of the consumer, if they knew the amount or would suggest some impartiality on the part of the broker. Firms always had an obligation, a principle, to act have regard to the interests of the consumer, to be clear, fair and not misleading in their statements to consumers. So all of these rules were in place. What's absolutely fair to say is that the Court of Appeal has added to that, has provided both a legal framework, a legal architecture based on the common law, as Nikhil said, which is different to the one that certainly our rules weren't predicated on that basis. They were sort of independent to that. So the court's provided a different legal framework and has provided some specific areas where it says the firm should have gone further. But they are specific areas where they should have gone further rather than there was no disclosure and now. So I just think there's something, so the narrative occasionally gets a little bit binary.
Can I just raise with the committee one of the more outlandish stories that I've heard about car finance, and that's, I understand when you were going to buy a Porsche, I'm sure that the committee will be well aware about that process, the waiting list was so long that you could find your way up the list if you bought a particularly expensive watch. Do you think that really happened?
We'd have to look at the details of the case.
That would be a matter for the FCA. I think it's a world that not of us don't move in, Dame Siobhan, even if we do.
And I think if the consumer were buying the watch, that might be one thing. I think the closer analogy here would be if you get up the list because the broker gets a watch.
Well,
that would be different. Exactly. That would be very, very...
Thank you, Dame Siobhan. We had a glimpse into your world, clearly.
But
people have talked a lot about this being a complicated landscape, but frankly, it's a mess, isn't it? I mean, the FCA regulates, the Financial Ombudsman deals with complaints, and this has now ended up in a mess in the courts, which is leaving consumers in a mess. And it was interesting what you were saying, Mr. Braviner, about previous rules. You know, they had to be transparent, and so if they had to be transparent, how did they get away with it for so long before it got into this complicated legal mess?
Well, as Nikhil has said, we focused in that period, 2017 to 2021, on the practices which actually appeared to us to be the most harmful. It goes back actually...
But even prior to the FCA, they were required to be transparent. And
the OFT had rules in place which were broadly similar in terms of the level of disclosure, yes. I think that the car finance market has changed over the years. I think the use of commission-style arrangements and so on, I think, has developed over the years. So I don't think it's nothing's a static market. And I think when our work started in 2017, we focused on the practices which seemed to us to be, they weren't strictly speaking, unlawful in the sense of there was no ban in place on discretionary commission arrangements. And just so that everyone's clear what a discretionary... People understand that...
We'd perhaps just explain it to those who may be watching.
Yeah, so the structure of a discretionary commission arrangement is that the consumer needs to buy a car, speaks to the motor dealer, I'd love this Porsche, and they haven't got £250,000 in their back pocket, so they need to agree finance. The broker, the motor dealer turns into, miraculously, a broker at that point and says, I will introduce you to a lender that I have. The interest rate is going to be such and such on a loan for £250,000 car. The discretionary commission arrangement was an agreement between the lender and the broker that the broker could increase the percentage interest rate that the consumer would pay, usually between a band, so a minimum of 3%, say, and a maximum of 15%. And the higher the interest rate the consumer paid, the higher the commission the broker got. That, on its face, is inherently creates a conflict between the interests of the consumer and the activities of the broker in a way that a flat commission doesn't have that in it. So we focused on...
But that's what I mean with the OFT had said be transparent. That transparency wasn't there. So it's one unholy mess that's landed now on you as well as consumers, and it's going to take a long time to resolve. So why did it fail so badly, even before you got involved, if that transparency requirement was there and people were not being transparent? I mean, it was just a breach of the previous rules, wasn't it?
In some instances, it was a breach of the rules. The rules were framed around the brokers had to disclose a commission if it was going to influence or could influence the consumer's decision, or suggest that they weren't being impartial. I think most people hearing the description of the arrangement that I've just described would think that should be disclosed.
Yes.
A generous interpretation would be that as the market was developing, some ambiguity perhaps existed before we stepped in as to the understanding of what the requirements were. But as you say, this has been in place for a long time. The practices pre-existed as the requirements for transparency pre-existed our work, and it was our work that really shone a light on it and stopped it.
Okay, well, can you just be clear, perhaps one of you, maybe you, Mr. Rathi, if you're a consumer who thinks you're caught up in this, what's your advice at this point?
If you are not satisfied with the terms of your finance agreement, you should contact your lender and put in a complaint to your lender if you are concerned.
First of all, you need to find your finance
agreement. But if you're satisfied, then obviously we wouldn't suggest you complain. So that's the advice we are giving to consumers.
Of course, there will be plenty of people who would have been quite satisfied because they didn't know what had happened. So they didn't know what they didn't know.
Yes.
And now they're retrospectively going to have the opportunity, like with PPI, to take advantage of potentially a redress mechanism. It does beg the question about where this issue of consumer awareness and responsibility begins and ends. Now, except if you've got a concealed commission arrangement between a broker and a car dealer, then obviously it's not fair. But also many people, and we've seen a complete transformation over the last generation of people not buying cars outright, buying their finance agreements. They almost take a view of, well, can I afford it? Is that right? So how do we sort of also get to a point where consumers are take responsibility, reasonably take responsibility, versus now sort of take advantage of a retrospective interpretation of a regulatory failure over many years, which will have a destabilising effect to a number of potentially financial institutions, many of whom are highly concentrated in this industry? Or is that the wrong way of looking at it?
So I'm not sure we would agree with the analysis around regulatory failure. I mean, these are complex issues around the law as well, which is not clear. So there's different dimensions to this. If we get to a structured redress mechanism, and I did say earlier in the year that as this work has been going on, there is a greater likelihood of that than when we started this work, and now we'll have to see whether the courts get to. One of the choices that we will have, and if we would go down that route, we would consult on it, is it complaints-led or is it system-wide? So is it one in which if you are dissatisfied you complain and then you opt in, or is it one where we say to the entire market you have to go and trace all your customers over whatever time period is decided and pay them? That is a choice, and it goes straight.
The second may be cheaper than the first.
Exactly, that's true, but it may be quicker, it may be easier to administer, and not all records are kept, but it also goes to the point that John Glenn MP is raising, which is there may be customers who are perfectly happy with the arrangement that they had, even sometimes if they had knowledge of this, because they were happy with the car, they were happy with the rate they were paying. So in the interest of the overall market functioning for the future, what's the right balance to strike? Yeah. And when these issues come up, it's exactly through this accountability mechanism we need to be able to ventilate these kinds of
these issues come up. How many other cases do you think there might be in other sectors? Are you doing any landscape review? Are there any other areas?
We are working on a range of issues where there are significant complaints. This is obviously the
complaints. That's where you're.
Yeah, we look at those. There's obviously this one is obviously of a scale which is there is no comparable one to this. I think it is known in the market, and we have been doing work on the question of ongoing advice charges in the wealth management industry, and that is ongoing work. And a couple of firms have made their own announcements around that work. But a part of what we want to do with the work we're doing on redress is, and with the FOS, is get early warning of these types of situations so we can act, but also prevent them from happening in the future.
So which sector you've mentioned there? So the financial advice sector. Any other sectors you want to name?
At this stage, I don't want to name anything else, unless Stephen, you want to add anything.
You are looking at other sectors.
We monitor the complaints, and we seek to get ahead of those issues and take action. So I'm not naming this as a sector, because I don't think this is good. This is one where you're going to have mass complaints. But one of the things that triggered our work on bereavement recently is we were seeing the complaints tick up around the speed of life insurance payments when people lost a loved one. We moved in, did a study. We've published that study, and we wanted to get ahead of it so that firms sort that out. Some firms are doing very well, by the way. So it's always important to acknowledge that. It's the firms that are not doing well. We want them to sort that out before it becomes an issue.
And there are some areas that are regulated. So, for example, fees for mortgages or courier fees for loan documents, which if you work out the maths on it, means that the interest rate goes up. So anyone who doesn't do the maths might well get stung. They're regulated by you. This is all perfectly legal. But do you look at those, even though a lot of people wouldn't complain because they wouldn't even really perhaps appreciate that they're paying over the odds for something as simple as having, the worthless documents couriered to them at a fee that basically ratchets up the interest rate. So hidden fees, basically.
There's two issues there. One is the fee, and one is the disclosure around it. So on disclosure on mortgages, for example, there tends to be in the key information document fairly extensive disclosure of the amount that's paid to an intermediary if you're taking a broker. The fair value limb of the consumer duty is intended to make sure firms think about what they are charging is reasonable for the service they are providing. And those are matters of
But take, for
judgment.
example, there's a mortgage fee and an interest rate that's lower. A higher interest rate, but if without the fee, but actually it's cheaper on the higher interest rate. People might go for the headline interest rate if they don't think it through. With the consumer duty, do you not think that there's a responsibility? I'm just picking one of them. There are many examples like this, but this is one that don't you think there's a responsibility for banks and mortgage lenders to think about the customers who may be making these decisions?
Yes, and that's why they typically a mortgage sale will often be advised, and the precise calculations for an individual customer will often depend on the quantum of the mortgage they're taking. So sometimes the lower interest rate but higher fee is worth it for them because of the amount they're borrowing, whereas if it's a small amount they're borrowing, going for the higher interest rate is better. And so the mortgage lender should make available to them the illustrations of what the different products will cost them, both on a monthly basis but then also over the lifetime of the mortgage. I think we think both products are legitimate products in a market where you have choice, and consumers then need to take a view as to what works for their particular circumstances.
I'll just go back to the fact you're monitoring complaints, and that is really, it's what you're saying is when that's how you decide that you might need to look at a sector. So to do that, for instance, the report on bereavement that you did, is there any other data that you look at to try and assess what might be going on in sectors?
So we have complaints is one source of data. We have extensive regulatory reporting, and we're looking at in our regulatory returns from each of the sectors, and we'll be looking at the financial health of different sectors, the compliance breaches, the operational breaches, the customer service data that you see when, say for example, in the savings rates work we did last year, and we informed the committee about this. We were seeing there were serious problems in the transfer times. When people wanted to move from one cash ISA provider to another cash ISA provider, we put a plan in place around that and put some focus around that. So there's a range of data that we use, and that's exactly, and now we're increasingly using data science, artificial intelligence, machine learning, all of those techniques to try and get to some of the issues faster.
And when you found a sector where there's a problem, so with motor finance, the hidden commissions, do you then look at other sectors, and are there any other sectors where you say, take hidden commissions, where that is an issue that you're going to look at, so where you may not have had complaints because people may not have realised, so that you're on the front foot basically as the regulator?
We are doing some work as to whether there could be any read across, but I'd be quite cautious about immediately asserting that there is. There's a lot of speculation out there. That requires quite
you patient, are doing some work. So what work are you doing? Just to explain what you're doing.
We are working to understand the judgment. As Stephen said, we'll wait to see if that is the final judgment, and we'll hear from the Supreme Court. But if that is the final judgment, we are then looking to see across consumer finance and other retail markets whether there may potentially be any read across. But the Court of Appeal was also quite clear in its judgment that there were certain elements of it that were quite specific to the facts of the cases that were before them. So that's why I don't want to suggest to the committee that there's automatically going to be read across much more widely, because I think that would cause a lot of concern for no reason. But obviously, as a responsible regulator, we are seeking to understand that.
I just really want a reassurance that you're not just relying on complaints, but you will be proactively looking at nods there from the panel. Yes. Okay, thank you. Chris Coughlin, MP.
Thanks. Just a quick one from me, because we've kind of touched on it already. On the FCA versus your international peers, there's obviously scope for significant deregulation in the US following the presidential election. So is that likely to pull the FCA between the EU and the US if there's further sort of divergence between the two, and how should the FCA respond to it?
Sure. It's a really, really good question. I think you can see the sort of apparent direction of travel in the US. I think it's right to point to that. I think the UK has followed a pathway for some time as a leader in the formation of international standards, whether that's through IOSCO, participating in the Financial Stability Board or otherwise. I think that remains an important function and objective of the FCA, notwithstanding aspects of apparent deregulation, or actual deregulation in the US. I think internationally, as a global financial center, there's a question of where in the globe should we be cooperating and why. So obviously there is a continuing discussion about Europe. Our interactions with our counterparts in Europe, regulatory counterparts in Europe, are very, very strong. We've seen recently, and quite interestingly, I think a direction in Europe is not dissimilar to the emphasis on the relationship between regulation and growth, as we are seeing here. And although post-Brexit, I think the conversation around aspects of what we do which relate to things like market access will take some time, but they're nevertheless worth having, without any doubt. So I think broadly, because we've seen the advantages that can arise from influencing and embedding international standards in the UK, that is not something we should be abandoning. As regulators, we often talk about or use the phrase race to the bottom.
Yeah.
And I think from my point of view, and I think from the organisation's point of view, there are clear dangers in indulging in any sort of race to the bottom around a sort of deregulatory agenda. For obvious reasons that go right back to our experiences in the financial crisis 15 years ago in practice. So I think there is on the whole, there is a lot to be said around pursuing agreements around the international standards which inform our own regulation with Singapore, with Hong Kong, with Japan, with Europe. But also, I think the reality is that once the sort of the leadership of our counterpart agencies in the US take up their roles, my experience in the past, in fact in the last Republican administration in the US, is that by and large the level of participation around global issues and global risks is quite encouraging in practice. So, of course, it's going to be important that we are on the front foot in relation to our ability and our ambition to engage with the US. But I perfectly understand the question around, is this kind of a binary choice of some kind? I don't think it needs to be. But I think the key point for us is that I think we need to persist in our sort of leadership role in relation to international standards. Just by way of example, we haven't touched on it today, but roughly 50% of global financial assets sit outside the banking system now in so-called non-banks. It's a really, really important topic. It's vastly important. It's one of the reasons why one should not separate wholesale from consumer in the context of financial regulation. Just look at the degree to which private equity ownership of real economy assets happens. But the work we have been doing around the relative lack of data to judge the level of leverage within private markets is really, really important, and we're co-leading that in the Financial Stability Board. I know that sounds a long, long way away from the discussion we've had about motor finance, for example, on the ground, but that sort of work is really important because it goes to critical elements of financial stability, which, if it goes wrong, of course, affects the whole population. So our positioning as a global financial center in creating the standards that are overall protective, but also reduce frictions around cross-border capital flows, which is essential to the way in which financial services sector, the wholesale sector, operates in the UK as an exporter of financial services and as an intermediator of financial flows.
Thank you very much. Harriet Baldwin, Dame Harriet Baldwin MP.
Thank you very much, Chair. Can we focus a bit on the organisation itself for a moment? You've increased your costs to the industry and your headcount by about 30% over the last 2 years. Is that?
So we've gone from around 4,000 in 2020 to around just over 5,000 today. So yes, those are the numbers.
And is that now enough people, or are you planning to increase headcount on a similar trajectory in the future?
What I've said both internally and externally is that we're not anticipating further significant growth. So the focus now is on optimising our resources, on our technological infrastructure. That is without prejudice to anything the government or Parliament might ask us to do, which sometimes things come along. But that also then opens up a discussion around the prioritisation of our resources across the priorities we talked about at the start. It's a large waterfront, and that means we're not going to cover everything to the same intensity and same degree. And therefore there will, which is why we, in the letter that Ashley and I wrote to the Chancellor, which was published this morning, we did want to say, look, what can we have this discussion around the appropriate risk appetite, and then we can make the allocation of resources.
In terms of resources, the 30% increase, would you say that's directly down to the additional responsibilities that you've been given by successive governments and parliaments?
It was some of the additional responsibilities, some of it was having left the European Union. There was an adjustment in terms of who's making the regulation now, so there's a very extensive process of moving the regulation that was made at EU level and decided at EU level into the domestic system, and that's being delegated to us. So in our case, around 30 to 40 files, which were EU files, are now coming onto our rule book, which are down to us to make the policy for and implement. Some of it was responding to some of the findings of the various reviews, and some of it is also stepping up in certain areas. Authorisations are seen as the biggest increase. We wanted to get faster there, in particular, and in our tech change.
Okay, so it sounds as though there was a step change and that your trajectory is a flatter one going forward, but you had a loss in your accounts because of the pension scheme accruals, and Dame Meg and I are both trustees of the Parliamentary Pension Fund,
which we should declare. Yeah.
I think it's been a really good time for the markets, so I was a bit surprised to see that you'd had actuarial losses on the FCA pension scheme. Should we be worried?
I wouldn't. I think our scheme is well funded, and it doesn't cause us any cause for concern, both in terms of the agreement we have with the trustees. I need to get back to you on the specific accounting treatment. Those numbers can move around a lot from year to year, and obviously the NAO looks at our accounts. So
we shouldn't be worried.
That's not on our sort of red risk concern that goes to the board or anything. Yeah.
Many other big ones.
In terms of absorbing that number of extra people over the last 2 years, has that been straightforward on onboarding that many staff? Have there been any particular areas where it's been hard to recruit?
Stephen may wish to add here. I mean, it was a very ambitious transformation that we underwent. I'm incredibly proud of the work of my colleagues and the 5,200 people at the FCA, the work they do day in, day out to protect consumers and ensure market integrity. We put through some very challenging reforms around our pay and performance, and we were particularly rigorous around tackling those areas where there perhaps wasn't the level of performance that we wanted to see going forward. And I think that's been well telegraphed in this committee over the years. But I think now we've seen some very strong staff survey results in the last year. We want to keep focusing on that, keep working on that. We obviously had a big training exercise to do, particularly in authorisations, as we brought on more case officers. We also have a big capability issue, which, like any large organisation like ours, from the most senior people in the organisation through to the new staff we recruit, around data and digital fluency. So we have significantly increased the number of data scientists and tech colleagues. We went out to Leeds and Edinburgh to bring more of those in, because it is competitive here in London, but the skills and capabilities we need to build there are not just in those areas. Every single person in the organisation needs to build their data and digital fluency to make best use of some of the new techniques that we're bringing to bear, and that is a fundamental retooling of public services, I would say, that we're embarking on.
And then what's the FCA policy on working from home? How many people would be working from home on any given day?
For senior leaders, so that's at roughly the top 175 in the organisation, the expectation is half your time is spent in one of our offices over the month, or if you're visiting a firm, that's included that, or in a court if you're in an enforcement case, and for the rest of the organisation it's 40% over a month, with some exceptions for different teams that might have specific.
40% in the office or 40%?
40% in the office over the month.
Not even half the time people aren't required to be in the office.
That's the balance we have struck. There are certain teams where it's a little bit higher than that. We're doing a review at the moment where we're considering all these issues in the round, like many other organisations, trying to strike the right balance between what is appropriate for the productivity of the organisation, our recruitment, our retention and our operational performance. We publish our operational metrics each year, and as you'll have seen year by year, they've been getting stronger, including in the last annual report. It also has enabled us to have teams that are operating in multiple different locations. So a large number of teams now operate out of Leeds and Edinburgh, 60 or 70 teams, and they interact with colleagues in London as well. And it's an ongoing discussion and debate with our colleagues, and we'll constantly look to what's happening in the external market as well.
So can I just ask on that, is there an issue for those who have sensitive data to
yes, there are certain teams that are full-time in the office because of the nature of the work they do requires them to use specialised equipment, which is only available on site. So that's what I was saying. It's not. There's a general rule, there's a general policy, but then certain specific business needs are catered for.
Thank you. I wanted to ask Mr. Alder, if you sit down and do you do a performance review of your chief executive on a regular basis?
Yes.
And what sort of things are you looking at when you do that?
Well, a range of things, but certainly, I mean, we've Nikhil's touched on transformation. As far as the organisation is concerned, how successful has that been? And I do recall, I think the first time I came to this committee, it was early last year, there were a series of questions about the level of turnover and morale in the organisation. And as you'd expect, we have a discussion around that. My current view is that Nikhil and his team have led a successful transformation. It's really important certainly from the board's perspective, given that the organisation has a series of challenging ambitions, which I think we're becoming more and more clear about. And we've discussed this earlier around how consumer duty develops, how we intersect with growth, how a secondary objective operates, and how we articulate our new strategy, that the organisational platform, or the platform with the organisation, people, technology, resources, is stable and is able to advance that ambition. That is not something I necessarily would have said, actually before I joined, say in 2022, when transformation I think was ongoing. I wouldn't necessarily have said I'd be all that confident that was the case, but I am now. And one other thing, I think in our discussions around where the organisation sits and going forwards is that question. Well, firstly, the degree of sort of thought leadership, which the organisation I think has been very clear that it is more than willing to contribute to the debate. I've been reflecting on the discussion today around trust and the question of trust in the financial system. There's a degree of ambition, I think, within the organisation. And I think Nikhil has started articulating this whole question of where risk sits in the system quite some time ago, which has now developed into a more sophisticated discussion around capital markets and proportionality and similar. But reflecting on this question of trust, there is kind of an ambition within the organisation. I'm sure it is shared by Nikhil and others. And frankly, it is an ambition. If you look at in essence, why should there be a low level of trust in financial services? It's not confined to the UK, by the way. It's a phenomenon in many jurisdictions. Fundamentally, it boils down to the harmful effects of distorted incentives within firms, within the sector, and it goes to information asymmetry. What we're effectively after, in many respects, is many of the tools plus consumer duty, and they all intersect, that we've been talking about, which are forward-looking, establishing a greater level of trust in the system.
This is all, motherhood and apple pie, but I'm not hearing specific metrics that you'd be evaluating the chief executive on in that discussion. And I wondered I was listening for, but I didn't hear, was how your metrics are going to shift with the new remit letter from the Chancellor.
Yeah, and that's something. Yeah, absolutely. I think the question of metrics for the organisation, it's a complex one, but fundamentally, Nikhil touched on this earlier on, it boils into two types of metric. Market impact metrics. So I think Nikhil talked about metrics that relate to the reduction of fraud in the system, for example, and activity metrics.
These are all metrics that you do evaluate the chief executive on?
Yes.
Yeah.
Yes. But critically, as we develop our strategy, we have 4 strategic pillars, which Nikhil went through earlier on. We're going to have to we're in the midst of developing that strategy so that we announce the kind of the full piece, as it were, quite shortly in the new year. As we're doing that, we want to establish the credible metrics that underpin those 4 pillars. And we need to be very, very careful about the distinction between activity metrics, that's just what we do, and market impact metrics. Market impact metrics are complex because it boils down to cause and effect. The degree to which what we do and what Nikhil and his team do as regulators, which affect a broader market outcome, say number of IPOs or reduction of fraud and such like. And you need to be really, really cautious around those sort of metrics. And we're working through that at the moment.
We look forward to hearing them. Yeah.
Well, obviously, you'll be as frequent flyers at this committee back in front of us to discuss that. Thank you very much. Dr. Chevensander MP.
Thank you very much, Chair. I want to talk about the Chancellor's Mansion House speech, the pension reforms she is about to set up. Maybe start with you, Mr. Alder, but maybe the other members of the panel would like to feed in. The merger of the local government pension fund is just to free up £80 billion, both in saved fees and higher returns. That would have to be standards by the FCA. I assume new standards to help meet those greater risks. What standards how do you see standards changing in the first instance? And secondly, are you prepared to enforce them quickly?
Mr. Ryan, who wants to go?
Okay, very, very briefly. Just broadly in relation to the pension reforms, again, they're a clear ambition. Certainly local government reforms 8 pools. Those managing those pools will need to be, some are already, but also will need to be FCA authorised. Clearly, the expectations of the way in which those pools are run would be broadly similar to the way in which we would look at pension schemes in the round. Clearly, those 8 pools would have choices as to how to deploy investments. The sort of regulation that we apply to asset managers, as you would expect, around systems and controls, metrics, etc., they would be fairly standard, I think, to start off with. But maybe I can pass over to Nikhil.
Mr. Rathi.
Yes, so we would envisage more local government pooling structures to come under our regulation over time. We also have consulted on a value for money framework, so we can look at long-term value and not just cost when it comes to performance of pension funds. And it's that the finalisation of those will also be subject to some decisions in DWP around how that applies to other schemes outside of the FCA remit. But of course, we would be ready to supervise against those. I would be realistic about the time frame there, because it's not a simple thing to simply say to a firm say to a fund you're underperforming and then shut them down. These things you have to. There are real world impacts on the pensioners involved if you move down that track. So sometimes I hear some quite sort of far-reaching statements as this will suddenly lead to thousands of funds consolidating very quickly. I don't think that is likely, but it provides a framework for bringing transparency to those that are underperforming, and then a ladder of intervention for us to use to take action there.
So what time frame are you thinking for the merger? How long do you think it will take?
Well, that is really a matter for the government. So the Chancellor set out the framework in the Mansion House review, and the phase one of that is now under intensive discussion. And I think it'll be a decision for the government as to what the timing is.
I think there's a difference between the local government schemes and then the broader DC market. The broader DC market is where we and others are working on the value for money piece, which, as Nikhil said, is around transparency on performance and returns and comparative transparency, and the sort of medium to longer term expectation that would be one element of consolidation. Whereas local government schemes, I think they're in a different bucket, which is around the 8 pools that we mentioned.
And as you guys are also very well aware of the fact that UK pension funds don't invest as much in domestic equity. So in the UK, it's 4%, across the world, it's 10%. And part of that clearly is around the returns. Now, the FCA, I know, does have some mechanisms to help improve those returns. So the early and high growth oversight framework, the AI lab. I mean, the question going forward is trying to raise return. This country are the FCA planning to do any more work in this area to help raise those returns here?
So the value for money framework is hopefully going to provide more transparency around the overall value that's provided over the long term, and then there's going to be disclosure around the geographic location of investments. It's really important, though, to stress we don't direct pension funds where they should invest their money. There are trustees, they appoint investment managers, they make the decisions that they consider appropriate for their members. And within the context of their fiduciary duties. Where there is gratuitous underperformance, and we can then intervene, but it's not for us to start directing. And the question around UK equities, as we touched on it earlier, there's a question of how much they invest in equities overall, and then the geographic distribution of it. So you may see some funds that invest significantly in equities, but they're directing it to the US or emerging markets because their judgment is that's going to generate better returns for their members. How you get to that is not really a regulatory matter. That's probably a matter for the Treasury and the tax system and other things.
As you highlight, lots of challenges there.
I suppose the point I'm trying to get to it more broadly is that there is a new world which you're moving into, in which the LGPS would be investing in higher returning funds, hopefully in the UK, where the FCA see itself sitting. Because clearly this is a very exciting, ambitious set of reforms, but your role will end up changing somewhat, I suspect. I do want to touch on the fiduciary duty as well. There have been some comments and remarks about the fact that fiduciary duty may need to change slightly to ensure those pension funds are invested in the UK, if indeed they don't seem to do so after this particular set of reforms have implemented in the way we would expect. Are you prepared for that? What are your views on it? And how quickly do you think you guys will be prepared to implement changes?
Yeah, so Dr. Sandler, I don't want to duck your question, but I do think that is a quintessentially political question. I mean, it is in other countries as well. It's a choice that legislatures make and governments make about whether they want, because some would argue that's protectionist, some would argue that it's necessary for the good of the economy, and that is a political choice. Of course, we would implement whatever.
Are you advising the Treasury?
We give the data, and we will share the data. But you know, we are also a global financial centre, and you know, one of the points around the success of our asset management industry, which is the second biggest in the world and one of the most international, is that people come from all over the world and have their assets managed out of the UK because they get advice about everywhere in the world where they may be able to invest those assets. And that openness is key to the success of that sector in our economy. And so the point you're making, but there is also an issue, and we all see it in terms of the investment in the UK. What I also hear when I talk to pension funds, for example, on infrastructure investment is it's not just about the desire to invest in the UK. It's also the certainty around planning and various other things as to how can they price the investment. Sometimes, for example, in a nuclear power station or renewable energy, where the regulatory framework has been fluid over the years.
Appreciate it. Thank you, Chair.
Thank you very much, Dr. Sander. James Siobhan McDonough, MP.
Again, great huge contrast in the areas that you cover, from international pension funds to vulnerable consumers. How well in general are firms dealing with those financial services consumers who might be thought to be vulnerable? Where do you have particular concerns?
So I think there has been a steady improvement here, and it is a limb of the consumer duty, and we've also put out guidance around vulnerability. The areas where we have had concerns most specifically have been the treatment of borrowers in financial difficulty, where we have stepped in, and I think we've secured redress of around 60 million for around 273,000 consumers, where we felt the communications of those in difficulty, those who are going into arrears, and the treatment of them in debt was not where it should be. And we've led the work with other regulators, particularly Ofcom, Ofwat and Ofgem, to make sure that the treatment of customers running into difficulty for debt is consistent across these sectors. Because one of the interesting things in the last year has been sometimes the debt has been the energy debt going first, not the financial services debt. So that's one area. Second area, which I know this committee is taking a close interest in, is access to cash. Since the new regime has come into place and the new rules have come into place, we've seen an announcement of 168 banking hubs, 92 are open. We have asked branches, firms in certain cases where they've been making adjustments to branches to pause because we haven't been satisfied their communications, including with respect to vulnerable consumers, have been satisfactory, to make sure that the alternatives are available, and we are working that through continuously now, and that is, I know that's going to be a continued discussion here with the committee. And the final point I'd make, again, it goes a little bit to the data. If we look at the mortgage market now, it's been through a very challenging period with the rise in interest rates. Notwithstanding that very challenging period, repossessions remain lower today than they were pre-pandemic. And I think that is something that says to us, we do think firms are taking their responsibilities seriously, and they are talking about how they can offer different options to people who find themselves in such severe difficulty, and only using the repossession route as a very much a last resort, and that's what the data from the courts is telling us.
Thank you.
So we're both going to get in trouble with the chair because she wants us to move on. So in November you published work relating to life insurers' bereavement claim processes. You said that there is a significant opportunity for improvement in the measurement, monitoring and delivery of good service outcomes for customers. How bad are things?
I touched on it earlier. I think there are some firms that do very well. Whenever we have these conversations, I think it's important to acknowledge that. Some firms have used technology. So, for example, there is technology available now to allow for electronic verification of death. So you can confirm to a degree of robustness that the claim is genuine quite quickly using technology, and then move forward to pay out at a moment of often very considerable need very quickly. Others make those who've been bereaved go through a lot of hoops and take 4 to 6 months to get that done. Lots of paperwork, delays, and we've called that out and asked for that to be addressed, and we'll be monitoring those firms closely. So I would say it's mixed. So I wouldn't say it's across the board bad, but there are pockets of poor practice which we want to see dealt with.
Thank you.
Just finally, pension plans. Can I just ask you about the 70,000 people who paid in for their pension, for their funeral in advance, because they are very serious, thrifty people who didn't want to be a burden on their families or on the state, and now find themselves burial plans. And now are without a paid-for burial. Do you think that, looking back, whether there is any way you could have done something differently? Because these group of people could be seen, because the companies that they were with were Safe Hands and One Life were particularly poor in terms of their aggressive selling, in terms of their risky investments. And while complaints were made from about 2017 and regulation came only in 2022, that most vulnerable of customer base now find themselves without a paid-for funeral. How can we help them?
It is very distressing to hear those accounts of people who have saved and now no longer have the confidence or the assurance that they thought they were going to get for their families with respect to funeral plans. This, and obviously Mr Glenn MP was a minister who took this he took this through Parliament. This goes to the conversation we were having earlier. Parliament decides our perimeter. We can only act once we've been given the powers. Sadly, when we were given the powers for funeral plans, there were some large providers who did not meet our standards, and they did not meet the financial viability test that we set. Therefore, we took the decision not to allow them in. And that was the right decision, and we would stand by that decision. That decision then has consequences, obviously, for those. There was a funeral planning authority. The regime the government of the day had in place was a self-regulatory authority. The funeral planning authority was in place at that time. And I think these transitions are always difficult, and I would say it here clearly to the Committee on Buy Now, Pay Later. It's not within our perimeter. We have taken some action, but I can tell you now, and you can read it in the press, there are some firms that have some poor practices out there. We are not taking action against those. We will deal with that intelligence at the point that it comes into our perimeter, because we don't actually, it wouldn't be appropriate for us to use our resources until Parliament has made the decision around that.
Thank you.
There are two kind of areas that I see are quite small that are coming up where people pay in advance for services, and they relate to money providers such as companies like Wise and currency providers. Do you have any concerns that those consumers are adequately protected?
I would refrain from commenting on a specific firm until I've understood the nature of the allegation. We obviously have a different regime on safeguarding for payments firms as we do to banks, and that's one of the points around what's the appropriate balance to incentivise innovation. There's a big fintech opportunity here, but it is an area where we have had significant concerns about the portfolio. And we've published those concerns around the quality of controls, the quality of safeguarding of assets. We've published letters to those firms quite robustly, including on the consumer duty. But in saying that, I'm not making any comment on the specific firms that you have raised there, but happy if you are able to send me the details, we can exchange correspondence on that.
It's possible that Dame Siobhan is the canary in the mine for you on this, so let's put that you in touch. But talking about the areas within your influence, in October you did announce that you would take some action against those social media personalities who use their platform to promote financial products, finfluencers as they're sometimes called. And you noticed that there'd been a particular increase in that, and there is a big concern about what they're providing and who they're reaching through the various social media platforms. Do you have any sense of what is driving the increase, first of all, in people providing advice online like this?
This is a global phenomenon. Okay. These influencers are getting attention right around the world. Some of them have tens, if not hundreds of millions of followers, of often people in quite an impressionable...
Do you think they provide a useful service at all? Is there anything good about what they do?
Well, the ones that we believe are acting illegally, we don't think are providing a useful service, clearly. We have, I won't get into the details of it, but you're aware, in May 2024, we charged 9. There's now a criminal case against them. To just give you some sense of the challenges here, we couldn't get a Crown Court date until 2027. For that complex case. So just the lead times and to Dame Harriet's questions around our resources, the resources for us in managing that process.
Exactly, resources must be huge. So how do you go and find it? It's like a needle in a haystack, is it? Or how do you someone have to
we monitor. So we
TikTok.
we are monitoring. Not
There's
me
a job opportunity.
Not me personally, no, but we are monitoring 100,000 websites daily using our sort of more
advanced
websites.
But what about
daily, and then we are monitoring influencer channels, and we also have sources of intelligence that come through to us and complaints that come through to us. We had a day of action against influencers in October, where we interviewed over 20 influencers under caution. I'm not going to comment any further on the action we may or may not take after conducting those interviews, but no one should have any doubt about our resolve to tackle those where we see harm that is operating outside the perimeter. Indeed, there are criminal sanctions here.
Is it actually possible to chase down people who are cutting across that line of properly regulated advice, which can be a vehicle? I mean, lots of people use social media, the BBC and others, quite properly. And then how do you, and those who are actually making illegal promotions and giving advice that they're not qualified to give? Will you be able to crack down, basically?
Our hope is that the action we have taken so far will have a degree of deterrent effect. There are other measures that are coming on stream soon. The Online Safety Act has now come into law. Ofcom is in the lead on that. We are working with them. Their priorities are child sexual exploitation, terrorist financing, but they will get to the fraud and other areas in about a year's time, and we're working very closely with them to make sure we're fully supportive of their work, and making sure the social media companies tackle influencers will be a key part of the online harms work that they are doing as well. We're not going to be able to chase down everybody. As I said, some of these are global. I mean, some of these are operating in jurisdictions all around the world.
In the Mansion House speech, the Chancellor carefully, I think it must be a carefully worded sentence, talked about the online platforms and fraud, and they were mentioned in the same sentence, but it was a warning shot. It read to me anyway, my interpretation, there's a warning shot across the bows. Is there a bit more behind that part of the Mansion House speech? Have you had discussions with the Chancellor and the Treasury about how to crack down on this?
This has been something that we've been preoccupied with for a number of years. When I became Chief Executive of the FCA, the firm I met most was not a financial services firm, it was Google, because your predecessors on this committee, Dame Harriet, Dame Siobhan, will know that we were having a major problem with the level of fraud that was coming from paid-for financial promotions on the Google platform. It took us a number of years. Eventually they shifted their policies such that they only allow financial services advertising from firms that are authorised with us, and the other major social media companies have followed suit. That's had a big impact.
But that's not the same as the influencers, is it? That's not the same as...
But then that's where it gets very blurry, because there can be paid for influencers as well, and sometimes there can be so there is some overlap there as well. We are discussing what the Treasury announced, but I really think that's for the Chancellor or the City Minister to announce what they are going to do there, but we are in discussion with on it.
Okay, well, I mean, I think this is an area that we've heard also from HMRC, that there are some issues there that they have with influencers, so I'm sure we'll pick it up further. Thank you very much. So if I can turn back to Dame Harriet.
Thank you very much. Just very quickly, really, because it was a surprise, I think, to the committee when we took evidence from the consumer groups last week. We asked them if they'd seen any impact from the implementation of the consumer duty, and they hadn't. And yet you've referenced it many, many times in your testimony today. And so I just wondered where the disconnect is there.
I watched that part of the evidence session, and I saw the range of responses. I thought the Which commentary was a little bit harsh in terms of seeing no impact. I think the measure they're using to some extent is, have we taken enforcement action yet? And we haven't. I mean, there are cases that we are considering, but we've always been clear that on a major change such as this, we're going to give the industry time to adjust. So the final rule of the consumer duty came in summer this year. We're not going to enforce against every technical breach. If we spot something, as a proportionate regulator, we will call that out to the firm, give them time to adjust before we take things further. But there are many other areas where I think we can point to a real shift. The work that the committee engaged with us on savings rates, we didn't go for a regulatory rule as a solution. We relied on the consumer duty, and we did see between June 2023 and June 2024 an increase in the average easy access rate from 1.66% to 2.11%. 100 million consumer communications went out, and we saw probably a faster rate of pass-through than we're seeing in other comparable markets in Europe or the G7. We've seen adjustments in some pricing mechanisms, for example, double dipping of platform providers, where they would charge you a fee to hold your cash and give you a lower interest rate, and you've seen other firms adjust their fees. We've seen changes in switching practices. We intervened on gap insurance, where we saw a payout rate of 6% of premiums in gap insurance, which versus the premiums being paid, and sometimes 70% paid in commission. We intervened in that market. That caused a pause of sales for some of those product providers. We intervened using the consumer duty. They adjusted their products. Those markets are now back up and running. And then there are other things where I think the consumer duty has added to the weight of the work we're doing, I touched on repossessions earlier. I do think that firms, as they're thinking about their approach to consumers in financial difficulty, are having the consumer duty in mind, amongst other regulation, as they're thinking about that. And indeed, our work on the advice guidance boundary as well will lean heavily on the consumer duty. So those are the things I would point to perhaps just balance some of the other evidence you heard last week.
Thank you very much. James, you want to come back in again?
No, I'm okay.
You and Jan, MP.
Thank you, Chair. Mr. Rathi, in previous years when the Bank of England base rate was still going up, our predecessor committee asked why banks were not passing this increase on to consumers in savings but were in mortgages. And I wonder if you think that there might be the inverse happening now that rates are starting to go down. How concerned are you that banks are taking too much of the profit and giving too little to consumers?
We've seen some adjustment in fixed rates in particular, which perhaps isn't so surprising given the forecast for fixed rates and where interest rates may go in the future. Although obviously it's not for me to comment on Bank of England policy. But as a general point, at this point, and we are monitoring this, we're not seeing faster move down of rates than we saw on the way up. I don't think I can give you evidence to sort of confirm that point. That's not what we're seeing at the moment. But we will keep a close eye on it and keep the committee updated.
Thank you, because certainly for consumers it's a massively important issue. And talking of consumers, when we were talking about motor finance, you said you were looking at other areas. I mean, we'd like to press you again in which other areas you might be looking at, or if you would be able to write to us with some information.
Yeah,
about
so I mean, I think you specifically asked me about commission arrangements, and so I was, or sort of redress situations. So I was limited in what I say, but there's a range of areas in the consumer markets more generally which we are looking at. I know this committee will be interested in motor insurance, and there's a motor insurance task force that the government has established. Within that, there are specific products like premium finance, where we do have concerns. And Dame Siobhan, you asked me about vulnerable consumers. We're particularly concerned about the impact on vulnerable consumers of what are actually quite high interest rates, effectively, if you pay monthly for your motor insurance as compared to an annual premium, and how well that's understood. Pure protection markets as well, we're looking at in the insurance sector, and we're going to be doing some work on the debt advice sector in the new year too, and the quality of communication. So those we will set that up, of course, very clearly for the committee and for the industry actually, so they know what we are focused on.
That will be very helpful, because it'll help shape probably our next session with you, among other things, and with ministers indeed. But can I thank our witnesses very much indeed. In summary, we've heard some useful information from the Financial Conduct Authority, and I think one of the things we were keen to tease out, and I think we have from you a bit today, that there is an inflection point here now, as you've got this trade-off between the primary and secondary objectives, protecting consumers and growth, and there is a tension and a risk element there, then that how that risk is managed is pretty key, and making sure that the system works for consumers but also delivers that secondary objective. So a very big challenge for you as an organisation. I think we heard some very clear messages about financial literacy from both sides, from both questioners and others, and really that motor finance is a bit of a mess, and that there needs to be some resolution to this. So we will look forward to questioning you about that once the processes have gone through on motor finance, which we hope. We're hearing different things about when court cases might happen, but we hope by next summer there may be some form of redress, but we know that you can't comment on that at this point. But can I thank Ashley Alder, Nikhil, Rathi and Stephen Braviner very much indeed. Order.